This lecture will be on the overview of double entry system. Before I dive into the double entry system, before we revise this concept of double entry system, let's first understand what exactly accounting is. And this is what a lot of students fail to identify, I would say, because they haven't been taught that way, right? So this is a new thing, right? And this is what I always tell my students, no matter what level they are at. Accounting itself is a language. My question to you is, what language? Because obviously language is a means of communication, right? What's a language? It's a means of communication, correct? My point is, what does this particular language help us communicate, right? Because that's the next question. If it's a language, it needs to help us, or basically it should help us communicate something, right? This is a language which basically helps us communicate the economics of a business transaction. Just do one exercise for me. Alright, pause this video and try to think of various business transactions. You know, you have this small shops, right, small general stores, to Amazon, Apple, Microsoft, right? Sorry, Microsoft, right? Facebook, right? Think of these businesses, small to large, right? Think of these businesses and try to think of some business transactions. You know, some essential business transactions. What? Sales, purchase of non-current assets, long-term assets, machines and stuff like this, right? And then you have, let's say, employees, you pay wages to them, right? And let's say you have, you know, your suppliers coming in and delivering you stuff, right, which is again essentially your purchase, right? You have financing, correct? You have the bank loan, you have raising equity through shares, right? Raising cash through issuance of shares, right? And again, you know that, and you've probably studied this before as well, that shares are of different types, you know, ordinary shares, preferences. That's the thing that we'll obviously look at later on as well. But the point is, there are a lot of business transactions that you can think of right now, correct? Point is, how do you, as a user of that information, understand what exactly this business transaction leads to? Any guesses? It's this thing, it's this language that helps you understand what this business transaction, you know, the consequences of that business transaction, you can say, right? And you can only understand that when you know this language. Simple. You know, I enter into France, and if I don't know French or English, I would be entirely lost over there, right? Why? Because I don't know the two languages that are spoken over there, right? So the point is, in the business community, right, if you don't know accounting, you're lost. You probably don't know anything, I would say. Or you probably know how to do business. For example, you know, business giants like, you know, Mukesh Ambani, right? For example, Mark Zuckerberg. They're, you know, let's take two examples. Mukesh Ambani is an engineer, right? And Mark Zuckerberg is a techie guy, right? Do you think they know accounting? Or do you think they've studied accounting? Probably not, right? And this is why, in order to communicate, and remember one thing, be it Ambani or be it Mark Zuckerberg, they need finance for their business, right? They can let the investor know why to invest in their business. Yes, obviously they're good at it, because that's why, and that's how they've raised so much money. But the point is, what or who helps them communicate where the business is headed, who or what helps them communicate, you know, the forecasts of the business, you know, the future of the business, I would say. It's this language, accounting. This is why And this is the reason this language, knowing this language is very important. And if you're studying at this level, if you're studying at a professional level, or even at a fundamental level, you're at good hands, right? You're obviously doing something, you're learning something that is very essential and that has no probability of going out. Like for example, you've heard that human capital will run out soon because you have all the tech coming in, you have all the IoT, you have all the AI and ML, machine learning and stuff coming in, right? But at this stage, right, accounting is something that will be needed all the time as long as the businesses exist. All right, because like I said, there's no other language that helps communicate the economics of a business transaction or transactions as a whole. Okay, now moving on. The key to this language is any source document. Any source document that I call this as, that validates a business transaction. Any source document that validates that a transaction has taken place, for example, invoice. What does an invoice reflect? It reflects that a sale has been made, or if the invoice is incoming, that means a purchase has been made, right? For example, deposit slip, that means you've deposited cash to the bank. For example, cash voucher, right? For example, check. For example, credit or debit note. Obviously, these are certain things that we'll look into in very detail when we study the course, when we study the relative topic. But the point is, you've obviously heard of these terms, right? Invoices, checks, deposit slips. We've all been to the bank. We all probably have been there when we stand in line to deposit the check or to collect the check and stuff like this, right? The point is, any source document, and like I said, this is the very first step of understanding this language, right? The first step is you need a source document to validate any business transaction. Validate means to prove that a business transaction has taken place, and this is what we're here to report, right? The second step of account, remember this. You enter the impact, you enter the consequence, all right, of that transaction in the books of prime entry. And the reason why we call it books of prime entry, or the reason why we call it books of original entry, is because this is where your accounting starts. A lot of people are of this opinion that accounting starts from your ledgers. No, it does not. Accounting starts from your books of prime entry. The books where you first record a certain transaction that has taken place. Over here, there's no double entry. All right, over here, there's no double entry. And from your prior studies, you probably know this as well. You have sales day book that records all the credit sales. You have purchase day book that records all the credit purchases. You have sales return day books that records the sales return. Purchase return day book basically which records the purchase return. You have cash book that records the entire cash transactions. Petty cash, if there's a company that is maintaining a separate petty cash, that means a small amount of cash used for daily expenses. For example, the office needs tea, coffee, stationery, paper to print, right? Stuff like this. So if you have a petty cash balance, for example, for lunch and stuff like this, for reimbursing the vouchers to the employees, right? So if you have a petty cash balance, you separate a separate book of prime entry for this petty cash, okay? And finally, general journal. All the entries that do not fall in any of the above 6 books of prime entry are entered into the general journal. For example, recording of depreciation. For example, recording of amortization. For example, recording of impairment, right? So all of these things are recorded in general journal, right? Now, once you have recorded the evidence is what? The source document. Into the books of prime entry, right? Once you record the evidence, once you have a valid business document, the impact of which you record in the first accounting book, that is when you start summarizing at each stage. Guys, please focus on what I'm saying, the words that I'm saying. We start summarizing these transactions at each stage. The first level of summary we make is your ledger accounts, right? The first level of summary, this is summary number 1, I would say. Summary. And this is where these are just some ledgers I've put down, right? Obviously there are a lot of ledgers. There's a revenue ledger and all that, right? The point is, these ledgers summarize what's mentioned in the books of prime entry. How do they summarize it? By making sure that debit equals credit. Each and every transaction that you record in each of these books has 2 legs, right? One is your debit side and the second one is your credit side. And this is just a form of summary. This is just a form of summary, right? That is reflected in your ledger accounts. Alright, you have to make sure that you understand why we do what we do in accounting. Alright, otherwise you will never understand accounting. Remember this. You can, yes, memorize it, you can rectify it, but again, when you enter an exam, when you enter an interview, when you, let's say, go for a multinational company and they ask you this stuff, you'll be blank. And this is something that I will never expect from my students, at least. Okay, the point is, like I said, ledger accounts is the first level of summary, and we'll obviously look at this topic in much detail when we do the kit, plus when we do the specific content of this chapter, right? The point is, the level of summary that we make at this level is obviously not very precise. You elaborate. For example, for example, sales day book. Let's take one example, okay? So that you guys are clear about it. For example, like I said, sales day book records what? All credit sales, correct? Credit sales means the double entry for this is, and like I said, each and every transaction has 1 debit and 1 credit. You have receivable debit and revenue, or as you call it, sales, right? Sales credit. All right. Now the point is, within the ledger accounts, you will have 2 ledgers that will be impacted. Number 1, the receivable, and number 2, the revenue. Okay. These 2 ledgers will be impacted. On the debit side, when you record a receivable against revenue, that means the company has earned some revenue, but it has not yet been realized in the form of cash. Make sense? And when you record a credit on the revenue side, again, we know that there are 5 accounting heads, right? So revenue is a form of income, increase on the credit side, correct? If we record revenue on the credit side, that means against receivable, obviously, that means we have realized, or we have basically not realized, we've earned some revenue, but not yet realized in the form of cash. Simple. Because the reason why we recorded a receivable against revenue means that yes, we've earned this revenue. Earned means that we've delivered the goods, for example. We have transferred the control of the goods, right? We have given out the services, but we have not yet received cash against it. Receivable itself is a proof. It's an evidence that basically tells the user of information that, okay, fine, this revenue is there, but we still haven't received the cash against it. Okay, it's a right to receive. That's why we call it receivable, right? Now, ledger accounts, like I said, summary number 1. What's the second form of summary? Trial balance. Have you heard of it? TB, trial balance, right? You record all the ledger balances, the closing balances of all the ledgers on the debits and on the credits of a statement which is called trial balance. And remember one thing, like I said, debits will always equal credits. Not even by a single penny, one will overstate or understate the other. Okay, so it's always debits equals credits. Okay, now once you've had the trial balance, there's just a difference of presentation, and this is where it where it comes, right? Let me tell you the basic accounting entry, which I've shown at the end of the slide as well. Correct? And if I further bifurcate this, so let me call it opening capital plus profit for the year minus, this is just a proprietor's account, I'm not talking about companies over here right now, is equals to closing capital, right? And with this closing capital, you add your liabilities to balance the equation, right? Remember one thing, how do we get this profit? It's two things: income, and we get a profit when income is greater than expenses. If income is less than expenses, you incur a loss, and if it's a loss, what do? Opening capital, it becomes minus loss. Correct? Now my point is, look at the equation closely. Do we have all the accounting heads? Yes. Do we have assets? Yes. Assets increase on the debit side. Do we have capital? Yes. Capital increase on the credit side. Do we have income? Yes. Income increase on the credit side. Do we have expenses? Yes. Expenses increase on the debit side. Do we have liabilities, final, which is the fifth one? Yes. Right? Liabilities increase on the credit side. My question to you, like I said, is, do we have all accounting heads? Yes, we do. If we have the all accounting heads incorporated, that means the accounting equation is complete. And if the accounting equation is complete, it's a matter of, like I said, presentation only, right? It's a matter of presentation only, where you say that, okay, fine, let's bifurcate these accounting heads into separate statements, and that set of statements, what is it called? Right? It's called financial statements. Alright? It's called financial statements. SOCI, Statement of Comprehensive Income. It's income and expenses. Alright? SOFP, Statement of Financial Position, is assets equals capital plus liability. Right? SOCF, Statement of Cash Flows. It's basically how much cash the company has earned. SOCI, Statement of Changes in Equity. What movements in equity have taken place during the year? What movements in equity have taken place during the year, right? And finally, notes to the financial statements. That means descriptive notes describing each and every, not each and every, in fact I would say at this level you need to know that all material transactions, because obviously numbers are insufficient to tell you what exactly is going on, right? For example, previous year my assets were 500,000. Current year my assets are, let's say, so let's take an example, 2019 my assets were 200,000. 2020 my assets are 500,000. This change in 300,000, that is evident, correct? The change in 300,000 is evident. Why? the user of this information, the user of financial statements, would want to know why or how. Okay, how did this happen? Why did this happen? Okay, and obviously, you know, have you heard this term? It's all relative, right? It's all relative. Honestly speaking, it's all relative. You can only, for a user of financial statement, you can only make sense when you relate this number to something, when you relate this change to something. All right. So like I said, the objective of this small short video was to, you know, open up your mind about how things work in the accounting world. And obviously we will dive into each and every stage, the books of prime entry, the ledger accounts, the trial balance, and obviously the financial statements at, you know, at each stage, as we move on with the course. Okay, so that's it for today, guys. Take care, stay safe, stay home. Goodbye.